Welcome to Counters. In this lesson, we're going to be looking at the accounting equation. We're going to look at it specifically when you have the issue of VAT. That's input VAT and output VAT. And by VAT, we're talking about value added tax. Now, we have done the accounting equation before. We have looked at the first lesson where we looked at the basic accounting equation and looked at how it affects the assets, equity, and liabilities, as you know what the accounting equation is. In the second lesson, we look at the accounting equation with the addition of your debit and your credit. So we added those two columns. In this one here, we have the exact same accounting equation with the debit and the credit, and we use the exact same examples that we used before. But in our previous lesson, we ignored VAT. So in this one here, we're going to take into account VAT. Now, if you've not checked out our first two lessons, I would encourage you to check those ones out before you check this one out, because we're going to go through this one very quickly. So if you already know what the accounting equation is, this should be a bit more easier for you. But if you do not know, you can check out those ones first, and you'll find them in the links in the description below. And we say that the accounting equation shows all the accounts that affect the balance sheet, that is the statement of financial position, and establishes how each transaction relates to the balance sheet. This is a great foundation for an explanation of the double entry accounting system. So we'll see how VAT is accounted for in the accounting equation. In the examples to follow, we will show how each transaction is recorded as a journal, and that is the debits and the credits, and show how it will be recorded in the accounting equation. So we'll also show how VAT will be recorded as a debit and a credit, and how it affects the accounting equation. So let's go and see our examples here. You can see we have example 1 all the way to number 10, and we have to go through each transaction and apply it in doing the accounting equation. And you can see here we have the format, accounting equation with debit and credit. We have the number, we have the account that will be debited, account that will be credited, and then we have our assets, equity, and liabilities as the accounting equation is. We are asked to complete the accounting equation, show the effect, that is the positive and the negative sign, and indicate which account is debited and which one is credited. That's what we did the last time as well. But here we are told that we must assume that all amounts include VAT at 15% where applicable. So we'll include VAT at 15% where it is applicable and include them in the accounting equation. So we're going to go through each an example one by one, and we're going to go through this fairly quickly because we have done the accounting equation basically in our other lesson. So here we're just adding the aspect of VAT, or the value added tax. So let's look at the first one. We are told that you paid 2,000 Rand for advertising. So let me remove the other question, and then I'll just display the one we're doing so that we can save some space. So here's the first one. Obviously, we are told here that K Acre is an entity that uses the perpetual inventory system and had the following transactions during the month of August 2020. Now, we have done and looked at the perpetual inventory system in a number of lessons. We even looked at how inventory is affected when you're using the perpetual inventory system and how the recording of VAT takes place. So you'll find the link to all these lessons that I'm mentioning in the description below. So if you paid 2,000 Rand for advertising, what is the account debited? What is the account credited? And how does it affect our assets, equity, and liabilities? Well, let's identify the accounts first. The account there is advertising, which is an expense account. You check out our lesson in the description below if you do not know where your assets decrease or increase, your equity decreases or increase, and your liabilities decreases or increase. We'll give you a very simple tip for you to be able to remember this. So advertising is an expense, that's one of our accounts. And then bank is another account because we paid the money. Whenever there is movement of money to or from our account, then we know that bank is involved. And then what is the other account involved? Well, whenever you are paying an expense, you will have input VAT. Obviously, that's if it's applicable for that particular expense. And whenever you are gaining or you're earning an income, then that is when you have what is called output VAT. And output VAT meaning you owe the revenue authority, because output VAT means you have to send it to the revenue authority at the end of the period or whenever the requirement is. But input VAT is what belongs to us, so it's an asset. So always bear that in mind. So the first account there is advertising. And what is the amount for advertising? Well, we must mention this. Our incomes and our expenses must always exclude VAT. So advertising is an expense. We must exclude VAT. And remember, we're told in the question, we must assume that this amounts include VAT where applicable. So obviously advertising is an expense and it has VAT in it. So we have to remove the VAT. So this 2,000 Rand is the 100% plus the 15% VAT. So we have to remove the VAT. How do we do that? Well, we'll take the 2,000 Rand times 100% divided by 115 and we get an amount of 1,739 Rand 13 cents. Now, if you do not know how to remove VAT or to get the amount including, excluding VAT and all that, we've done a simple lesson where we showed you how the formula works. You'll find the link in the description below as well. So we'll put that amount 1,739 Rand 13 cents in which section? In the equity section. Remember, expenses decreases our equity, so we're going to put it in the equity section as a negative. And now we have just done our advertising account. Remember, our incomes and expenses go under the equity column because the expenses decrease our equity and the income increases our equity. What is the second account that is affected here? Well, the second one that is affected is input VAT. Remember, I mentioned if we have incurred an expense, it's always input VAT because we're going to pay that expense to whoever we owe that expense, and then we're going to go to the revenue authority, especially as a VAT vendor, and claim back that money that we paid for VAT in that amount. Okay, so we're going to claim back the VAT portion from the revenue authority, and that's why it's input VAT. You can think of it this way: input, money coming in, or that money that's supposed to come into us, and output is money that's supposed to be paid out to the revenue authority. So whenever you pay for an expense, you're paying it to your supplier or whoever you're paying it to, and then you go back to the revenue authority and you ask for that VAT back. So our input VAT is an asset, and where do assets increase? Assets increase on the debit side. So we put the input VAT, and what is the amount there? We're going to take 2,000 Rand times 15 divided by 115, and we get an amount of 260 Rand 87 cents. Another way you could have calculated that, you could have taken the 2,000 Rand minus the advertising amount of 1,739 13 cents, and you will get 260 Rand 87 cents. Now, is this a positive or a negative? Well, it's a positive because input VAT is an asset. It's increasing our assets. So we're going to put plus 260 Rand 87 cents on the asset side. Remember, we have to show the signs whether it's positive or whether it's negative. What is our third account? Well, if you remember, I mentioned it. We paid this amount. That means bank is affected, and bank is an asset and it's decreasing. Whenever you pay for something or you send money somewhere from your bank account, always bank is decreasing, and bank is an asset, and assets decrease on the credit side. So we put the bank, and then once we have put the bank there, we put the amount, which is 2,000 Rand. Remember, we paid the entire 2,000 Rand. So we're going to put minus 2,000 Rand because money is leaving our bank account. And as you can see here, our assets must equal equity plus liability. So you can see on the asset side, we have minus 2,000 Rand and we have plus 260 Rand 87 cents. That gives us a sum of minus 1,739 Rand 13 cents. And you can see it's the same. Our assets equal equity plus liability. So you always check for that whenever you're doing your accounting equation after every transaction. Now, let's do the second one. We've just completed the first one. The second one says we bought inventory on credit for 50,000 Rand. Now, I'm not going to go into detail in explaining what the perpetual inventory system does and how it works and how you record it, but you should know that the perpetual inventory system records the movement of inventory after every transaction. Now, we've done extensive lessons on the perpetual inventory system. As I mentioned before, you'll find the links in the description below for those ones. So, what do we debit here? Well, we will debit inventory because inventory is coming into our business. So we'll put the inventory. And then what else do we have as an account affected here? Well, after debiting our inventory, what is affected? Is it input VAT or output VAT? Well, think of it this way. Are we buying something or are we selling something? If we are buying something, then we know that it's input VAT because we have to pay that money to whoever we are buying from, whether we've paid or not. We have to record VAT. So we have to pay that person. That means we'll go to the revenue authority and claim it back. So that's input VAT, and input VAT is an asset. So we put it on the debit side. And then what is the third account? Well, we're buying from our supplier, but we didn't buy it using cash. If we bought it using cash, it was going to be bank, but we bought it on credit. So it's going to be accounts payable. Now we've identified our three accounts. Now let's first record inventory. We bought inventory on credit for 50,000 Rand. Now remember, at the beginning, the question told us that assume that all amounts include VAT at 15% where applicable. So When we buy inventory or whenever we sell inventory, there is VAT involved there. So we have VAT in this 50,000 rand. So our inventory, whenever we record our inventory, we must always record our inventory excluding the VAT. So we're going to take the 50,000 rand times 100 divided by 115, and we get the value of our inventory, which is 43,478 rand and 26 cents. And what is this? Is this a positive or a negative? Well, we know that inventory is an asset, and if an asset is coming in, we're going to put it as a positive under assets section of the accounting equation. So we're going to put plus 43,478 rand 26 cents on the asset side. Now, what is the second one? Well, we have input VAT, and we're just going to record that one there, which is the 50,000 rand times 15 divided by 115, and gives us an amount of 6,521 rand 74 cents. And like I said before, you could have just taken the 50,000 rand minus this inventory amount of 43,478 rand 26 cents, and it would have given you the same answer, 6,521 rand and 74 cents. And we put that under input VAT. Remember, input VAT is an asset, so we put it under the asset side, and we put it as a positive because our assets are increasing. And the last one there is accounts payable. Now, accounts payable is whatever we owe our supplier. What we owe our supplier must always include VAT. And why is that? Because we can't just tell him that, hey, I owe you 43,478 rand 26 cents for inventory. That's all I'm going to pay you. That's not how it works. You have to pay him everything, and he's responsible to take that VAT and to give it to the revenue authority. So we are paying him the entire 50,000 rand. And accounts payable is a liability, and liabilities increase on the credit side. That's why we put accounts payable on the credit side, by the way. So we're going to put on the liability section plus 50,000 rand. And does our assets still equal our equity plus liabilities? Yes. If you count the total for your assets, it will equal your equity plus your liabilities. Obviously, we have nothing on the equity side, but we have 50,000 rand on the liabilities, which equals the total of the two that we have on our asset side. And we've just completed the second transaction. Let's do the third one. We are told here that you sold inventory worth 13,500 rand excluding VAT for 17,750 excluding VAT on credit. Now here they were specific to tell us whether it includes VAT or not. Now, whenever you sell your inventory with the perpetual inventory system, you have two transactions. One is for the recording of the sale, and the second one is for the recording of the cost of sale. That is with the perpetual inventory system. Like I said, we're not going to go into too much detail here. You can check out the other lesson in the description below. So what are the accounts here? Well, first we have to record the sale of the inventory. So how much did we sell it for? We sold it for 17,750 excluding VAT on credit. So whenever we sell it on credit, we have an account called accounts receivable. And accounts receivable is what our debtors owe us. So it could be called accounts receivable, it could just be called receivable or debtors control. Those words can be used interchangeably. So we have accounts receivable, which is an asset. Remember, whenever someone owes you, you record it as an asset. So we have accounts receivable as the account that is debited. The second account that we see here is whenever you sell goods to your customers, you have what is called sales. And sales is an income, and income is an equity account. And where does equity increase? Equity increases on the credit side. So we put it on the credit side as sales. And now that we've done that, we just need to record the VAT. Where do we put our VAT? Well, whenever you sell to your customers, you charge the customers for the goods, including the VAT, and then you'll have to take that VAT and pay it over to the revenue authority. So that's a liability to us. So liability increases on the credit side. So we put output VAT on the credit side. Now that we've identified and put our three accounts where they belong, what are the amounts? Well, the first one we have is accounts receivable. Whenever you sell to your customer on credit or whenever you sell it on cash, your customer won't just pay you for the goods, for the inventory. They will pay you for the inventory, including VAT. So this 17,750 that we sold it for excludes VAT. So we have to include the VAT. So we're going to take the 17,750 times 115, which is the 100% plus the 15%, divided by 100. And it gives us an amount of 20,412 rand 50 cents. So we put it on the assets side because our customer owes us this amount. So we put it as a positive. So we're going to say plus 20,412 rand 50 cents. And now that we have recorded that one, Let's record the sales amount. Now I'm going to say it here. The sales amount must never include VAT. Must always exclude VAT. So our sales amount is going to be the 17,750 rand. And we put it as a positive because the sales account is an income account and it increases our equity. And then what is the last thing? It's the output VAT. What is the output VAT here? Well, we can take the 20,412 rand 50 cents minus the 17,750 and it will give us the amount of the output VAT. And we put it as a positive. Alternatively, you can use the formula and it's 17,750 times 15 divided by 100 and it gives us an amount of 2,662 rand 50 cents. And we put it as a positive on the liability side because our liabilities are increasing, meaning the amount that we owe other people is increasing, and in this case, the revenue authority. Now we do the second transaction. Remember, with the perpetual inventory system, whenever you sell your inventory, you have two transactions, one for the sales, and the second one is for the cost of sales. So we're going to record the cost of sales. The cost of sales is an expense, and expenses decrease our equity. And remember, expenses are always debited. So we put the cost of sales as the account that is debited, and then we also put what is called inventory. Remember, whenever we sell goods to our customers, we record inventory. We're letting go of inventory, or we're giving the goods away to our customers. So we have to take out those inventory from our books. So we credit the inventory because inventory is an asset and it decreases on the credit side. So we put inventory, and then what is the amount here? We put the amount that we bought the inventory for, excluding VAT. Always remember that. So we sold the inventory, and this inventory was what? 13,500 rand, and it was excluding VAT. That's what we want. So we don't have to do any calculation. So we put 13,500 on the asset side as a negative because inventory is leaving our premises, and cost of sales is an expense and it reduces our equity. So we put the minus 13,500 rand in our equity side. And you can see from every transaction, from the two transactions we've just done, our assets still equal our equity plus our liabilities, if you'd like to confirm if you've done everything correctly. Now let's do the fourth one. Here we are told that you paid the supplier 10,000 rand for goods bought on credit. Now you paid your supplier for goods that you bought on credit some time back. So what are the accounts involved here? Well, the first one here is accounts payable. Whenever you pay your supplier, it's reducing your accounts payable. And remember, accounts payable is a liability, and liabilities decrease on the debit side. So we put the accounts payable, and you are paying the supplier. So remember, money is leaving our bank. So bank is an asset and it decreases on the credit side. So we put the bank. And what is the amount? The amount is the 10,000 rand. So we put minus 10,000 on the asset side for the bank and minus 10,000 rand on the liability side for the accounts payable. That was an easy one. Let's go to the fifth one. The owner took goods worth 4,000 rand, excluding VAT, for own use. When the owner takes goods for own use, that is what is called drawings. So that's the account that is debited because drawings reduces our equity. So we put drawings there. And the second account is inventory as the account credited. Why? Because inventory is leaving our premises. The owner is taking it. So we have to remove it from our books, and inventory is an asset, decreases on the credit side. And what other account is affected here? Another account which is affected here is VAT output or output VAT. Why is that? Well, because when we bought this inventory, we recorded what is called input VAT. We're telling the revenue authority, hey, you owe us this money because we bought inventory and we paid our supplier. But whenever the owner takes goods for his own use, that means the revenue authority does not owe us the VAT for those particular goods because the owner has taken it and made use of it. So we have VAT output to decrease the amount that the revenue authority owes us for these particular goods. I hope it has made sense. So what are the amounts here? Well, remember, the amount for the inventory has to exclude VAT, and we're told that the owner took goods worth 4,000 rand, excluding VAT for own use. So we put the 4,000 rand as a negative on the asset side because it's decreasing our inventory. And then on the equity section for drawings, we have to put the amount including the VAT. And why is that? Because when the owner takes goods for own use, it's not only is he taking the goods that we bought for 4,000 rand, but it's including the VAT. Remember, when we paid the supplier, we paid the supplier including the VAT. So we're going to take the 4,000 rand times 115 divided by 100, and we get an amount of 4,600 as the total cost to the company that the owner has taken I hope it's made sense. So put minus 4,600 on the equity side because drawings decreases your equity. And then we have VAT output. How do we calculate that? We'll take the 4,000 rand times 15 divided by 100 and it gives you 600. And we put that as a positive plus 600 rand. And you can see our assets still equal our equity plus liabilities. Okay. Let's move on to the sixth one. We're told here that you received rent from a tenant, and this is for a residential property, 4,900 rand. Why do they tell us that is for a residential property? Well, here in this case, there is no VAT applicable. Remember, they told us all amounts include VAT at 15% where applicable. Well, here they don't have to tell us that it's not applicable because we know that rent from a tenant is not VAT inclusive, especially if it's a residential property. So we're going to ignore VAT on this one, or we're going to leave it out. So whenever you receive money from a tenant, you have bank involved there. Remember I said if there's money going out or coming in, bank is affected, and money is coming in, so we have the account debited as bank because bank is an asset, increases on the debit side. And then we have what is called rent income. Rent income is an income and obviously increases on the credit side because income is part of equity. And what is the amount there? 4,900. So we put on the asset side for the bank money coming in plus 4,900, and the rent income increases our equity because it's an income, so we put plus 4,900 on the equity side. And that's it. We're done with that one. Let's move on to the seventh one. Bought equipment by check, 28,000 rand. So here they didn't tell us whether it's including or excluding VAT, but we're assuming that it's including because the question told us that assume that all amounts include the VAT at 15%. And we know that equipment includes VAT. So we know that this 28,000 rand includes VAT. So the first account we have there is equipment. And what VAT do we have here? Is it input or output VAT? Well, we bought the equipment. That means we're going to pay someone for those equipment. And that means we're going to go back to the revenue authority and claim that VAT. So it's input VAT, and that's the account debited because equipment and input VAT are both assets. And then we also have bank as the account credited because bank is an asset and it's decreasing because we are paying for this equipment. And what do we put as the equipment? Well, equipment must not include VAT. So we have to take out the VAT from the 28,000 and record equipment on the asset side as a positive. So we take the 28,000 rand times 100 divided by 115, and it gives us an amount of 24,347 rand 83 cents. We put it as a plus on the asset side because equipment is coming into our business. And the second one we have there is the bank. Remember, bank, when we paid for this equipment, we paid the full amount including VAT. So we put 28,000 rand as a negative because money is leaving our bank. And then for input VAT, what do we have? We have the 28,000 rand times 15 divided by 115, and it gives us an amount of 3,652 rand 17 cents. Another way we could have calculated that is by taking the 28,000 rand minus the 24,347 rand 83 cents. It should give us the same answer. And we put that as a positive on the asset side because input VAT is the amount that we are owed by the revenue authority. And we're done with that one. Let's move on to the eighth one. We are told that the cash sales of inventory was 25,000 rand. Markup was 30%. So we are given more information here, but we know whenever we sell inventory, we have two transactions that we'll record. First is for the sales, and the second one is for the cost of sales. So for the sales of inventory, what do we have here? Well, the account debited is the bank because we sold it using cash. So put there bank. And the second account we have there is our sales, and our sales amount. Remember, whenever we sell goods, we record sales. And the third one we have here is our output VAT. I hope you caught that one correctly. So our output VAT is affected here because we sold goods to a customer and they paid us the amount including VAT, and we'll still have to pay the revenue authority that amount. So output VAT obviously is a liability, and liabilities increase on the credit side. So we put output VAT as the account that is credited. And what are the amounts? Well, for the bank, remember, bank is the amount that we received including VAT. So put the plus 25,000 rand because money is coming into our bank. And then what is our sales amount here? Well, remember we said that whenever you're recording your sales or your income, it must always exclude the VAT. So we're going to take the 25,000 rand times 100 divided by 115, and we get an amount of 21,739 rand 13 cents, and that we're going to put it under equity as a positive because sales is an income, so we'll put that as a plus. And then the last one we have here is VAT output. So we're going to record it under the liability section as a positive as well. So we're going to take the 25,000 Rand times 15 divided by 115, and it gives us an amount of 3,260 Rand 87 cents, and we put it as a positive on the liability side. And as you can see, our assets still equals our equity plus liabilities. Now let's do the second transaction. The second one is where we record the cost of sales. That's the account debited because it's an expense. And then we also record inventory as the account credited because inventory is leaving our premises when we sold this inventory, and it's reducing our assets. And the amount there is excluding VAT. We have to put the amount excluding VAT. But this time, what is the amount for the cost of sales? Well, we want the amount at which we bought this inventory. So how much did we buy it for? Well, we didn't buy it for 25,000 Rand because we sold it for 25,000 Rand. And we certainly didn't buy it for 21,739 Rand because that's our sales. Remember, our sales excludes VAT. So that means we sold it at the markup of 30%. So we have to take sales amount and remove that markup to see what our cost of sales is or how much you bought it for. So what is the formula for that one there? Well, we're going to take the 25,000 times 100 divided by 115. Why? Because we're first taking out the VAT, and that will give us the 21,739 Rand 13 cents, and then we multiply that answer by 100 divided by 130 and gives us an answer of 16,722 Rand 41 cents. That is our cost of sales. Now it can look complicated here, but we did a specific lesson where we looked at margins and markups and how to calculate markups, how to calculate margins, and you'll find the link to that lesson in the description below. But basically what you're taking is your sales amount, which is the 21,739 Rand 13 cents, and you're removing the markup. So you're taking the 21,739 Rand 13 cents times 100 divided by 130, and that's exactly what we did here. We just took the 25,000 Rand first, including VAT, and we removed the VAT times 100 divided by 115, and it should have given you this answer. And then you take that answer and multiply it by 100 divided by 130, and it gives us the answer. And that is our cost of sales answer and our inventory answer. So our inventory is decreasing, so we'll put minus 16,722 Rand 41 cents on the asset side, and you also put minus the same amount on the equity section because our cost of sales is an expense and it reduces our equity. Let's move on to the next one. The ninth one is borrowed 25,000 Rand from Egor Bank. Now, whenever we borrow money from the bank, this one here, we do not record it including the VAT because it's a loan that we're receiving from the bank. Usually the VAT is not applicable here. So money is coming into our bank, so that's the account that is debited. And then what other account do we have? Well, we have bank loan or loan payable, or you may also put it as long-term loan, still the same thing. So we put bank as the account debited, and we put as the account credited the bank loan. And what is the amount? Well, we put plus 25,000 Rand on the asset side because money is coming into our bank, and we also put plus 25,000 Rand on the liability section because a bank loan is an amount that we owe someone else, and in this case it's Egor Bank. And that was the easy one. Let's do the last one, which is the 10th one. We are told that you purchased a vehicle for 100,000 Rand, and we are told that it's excluding VAT. And then a deposit of 25,000 Rand was paid, and the remainder would be paid in installments commencing in 2021. So what is the account that is affected here? Well, the first one there is the vehicle, because vehicle is coming into our business. We are debiting it, and that's why we put it as the account debited. And the second one we have there is input VAT, because whenever we buy a vehicle, we're paying the one who sold us the vehicle including VAT, and we have to go and claim it back from the revenue authority. So it's an asset, so we put input VAT there. The third one we have here is bank. Remember, a deposit of 25,000 Rand was paid. That means money left our bank account. That's why we're crediting the bank. And then the last one we have here is the car loan, because a car loan is a liability. We're putting it on the credit side because liabilities increase on the credit side. And then for the vehicle, we put the amount excluding VAT. Remember, for our assets, the amount has to exclude VAT, and the 100,000 Rand excludes VAT, so we put the 100,000 Rand. And then what is the second one? The second one is the input VAT, so we're going to take the 100,000 Rand times 15 divided by 100, and we get an amount of 15,000 Rand. And that's because the amount was excluding VAT, and we put that as a positive on the asset side. And then the next one we have is the bank, put it as a negative, which is the 25,000 Rand because we had to pay this deposit. So we put minus 25,000 Rand. And then the last one we have there is the car loan. You put the amount that we took for the car loan. And remember, if we pay 25,000 Rand, that means The rest was using the loan. And remember, we bought this vehicle for 100,000 Rand, but we had to pay the 100,000 Rand plus the 15,000 Rand VAT to the person who sold us the car. So it's 115,000 Rand. So we take the 115,000 Rand minus the 25,000 Rand that we put down as a deposit, and then we get 90,000 Rand. And that's the amount that we took out as a loan. So we put plus 90,000 Rand in the liability section because we're owing the bank this amount for the car loan. Now you can see our assets equal our equity plus liabilities. And that is how you do the accounting equation when you have input VAT and output VAT. I hope it has made sense. I hope you have gained value from this lesson. And if you have, please subscribe to our channel, like this video, and share it to those you think it might help. And if you'd like one-on-one lessons or one-on-one sessions with us, you can book a session with us at a reasonable rate, and you'll find our information in the description below. Till next time, cheers.